In this video, we will explore the basic principles of microeconomics. Microeconomics is essentially the study of the behavior of individuals and their decisions on what to buy or consume based on the prevailing prices. You can think of prices as market signals. They signal where the economy should direct its productive activities. The core philosophy here is that production levels and prices are ultimately driven by consumer demand. We also look at the theory of the firm. Just as individuals make decisions, firms adopt strategies to increase their profits. They have to make decisions at several levels, including inputs, outputs, prices, and production levels to manage their profits and losses. Understanding these concepts helps us determine how goods are distributed among various participants in the economy. Now, let us broaden our view and look at the basic principles of macroeconomics. While microeconomics focuses on the individual, macroeconomics looks at the big picture, which is the economy as a whole. Here, we focus on factors like aggregate supply and demand, unemployment rates, GDP, overall price levels, and inflation. There are two major influencers of public policy in this arena. First is the government, which manages fiscal policy involving revenue and spending. Second is the central bank, which manages monetary policy involving money supply and interest rates. It is important to note that the work of John Maynard Keynes, specifically his general theory, revolutionized this field. These principles help us understand the state of the economy, the drivers of income and savings, and how to formulate policies for stability. Next, we will look at an introduction to various macroeconomic variables. The goal of any policymaker is to ensure low unemployment, price stability, and steady growth. However, the reality is that economies experience cycles of booms and busts despite these best efforts. This is because multiple uncontrollable variables influence the outcomes. For example, the Reserve Bank of India raised rates between 2011 and 2013, but it failed to tame inflation because food prices remained high. To understand the economy, we look at national income concepts. Here is a simple equation: gross domestic product or GDP plus net factor income from abroad or NFIA equals gross national product or GNP. Essentially, GNP is the market value of goods and services produced by a country's residents, regardless of where they are located in the world. Let us dig deeper into the measurement of national income. There are three primary methods to calculate this. First is the product method. This focuses on the aggregated flow of goods and services from sectors like agriculture, industry, and services. We calculate the sum of outputs of various sectors, but the rule is to count only final goods to avoid double counting. The second is the income method. This focuses on the aggregate income of individuals. We categorize people into employees who earn wages, professionals who earn service income, entrepreneurs who earn profits, and investors who earn returns on capital. Finally, we have the expenditure method. This looks at the consumption end. We calculate aggregate demand by adding private consumption, government spending, gross capital formation, and net exports. Net exports is calculated as exports minus imports. Moving on, let us discuss the uses of national income statistics. These statistics are vital for three main reasons. First, they indicate the level of economic welfare and growth. They reveal the overall performance during a financial year. We calculate per capita income by taking the national income and dividing it by the total population. This is a better measure of the standard of living than just total income. If the population grows faster than income, the standard of living actually drops. Second, it shows the distribution of income. The income method reveals how money is split among employees and entrepreneurs, while the product method shows us which sectors are contributing the most. For instance, the service sector makes up about 60% of India's GDP. Third, this data supports policies on savings and consumption. A critical aspect of a healthy economy is the relationship between savings and investments. We must understand the constituents of savings. We have individuals who have personal savings, corporates who have undistributed profits, and the government which has public savings or deficits. The total of these gives us the national saving. However, saving is not the same as investing. We need a conversion mechanism. Financial markets play this role by being transparent, safe, and low cost. They channelize these savings into instruments like equity, bonds, and securities. These funds then go to productive venues to generate further earnings. The ultimate goal is to have higher savings plus higher conversion to investments, which equals a good outcome for the economy. We often hear about rising prices, so let us explore inflation and interest rate. Inflation is defined as a general increase in price levels leading to an erosion of purchasing power. For example, 1000 rupees buys fewer goods today than it did last year. We measure this using the wholesale price index or WPI for wholesale prices and the consumer price index or CPI for retail prices. Inflation is caused by two main factors. Demand pull is when demand is greater than supply. Cost push is when there is an increase in input costs. There is a strong link to interest rates. High inflation usually leads to high rates to motivate savings and reduce consumption. However, the impact of high rates is that it reduces investments due to the high cost of capital and slows down sectors like auto and real estate. Another key indicator is the unemployment rate and foreign capital flows. The unemployment rate is the percentage of the eligible and willing to work population that is unemployed. This is linked to the economic cycle. During expansion, production goes up, jobs are created, unemployment falls and income rises. During a slowdown, the opposite happens. We also need to compare foreign capital flows. Foreign direct investment or FDI is an active form where investors participate in decision making. It is long-term, stable capital that brings jobs and new tech. On the other hand, foreign portfolio investment or FPI is a passive form involving investment in markets. This is often called hot money because it can be pulled out anytime, creating systemic risk and high volatility. Now, let us examine fiscal policies and their impact. This involves the government's balance sheet. On one side, we have revenue, which includes recurring revenue from taxes and interest, and capital transactions like borrowing and disinvestment. On the other side, we have expenditure, which includes expenses on education, healthcare, defense, and welfare. If expenditure is greater than revenue, we have a fiscal deficit, which is bridged by borrowing. The impact of high deficits is that they push up interest rates. We also look at the current account in the balance of payments. This is the difference between exports and imports. A high current account deficit weakens the currency and leads to inflation. To mitigate this, we need capital inflows like FDI. We can categorize these strategies into three types of fiscal policies. First is neutral fiscal policy. The condition here is that income and expenditure are in equilibrium, so no major changes are required. Second is expansionary fiscal policy. This is used during recessions or a slow economy. The action here is to spend more and tax less. The goal is to put money in the hands of citizens and corporates to expand the economy, though this results in fiscal deficits. Third is contractionary fiscal policy. This is used during inflation or an overheated economy. The action is to spend less and tax more. The goal is to reduce money in circulation to cool down the economy, resulting in a fiscal surplus. Parallel to the government, we have monetary policies administered by the central bank. Their job is to manage money supply, inflation, and interest rates. An expansionary policy increases money supply and reduces rates. A contractionary policy reduces money supply and increases rates. The central bank uses several tools. The repo rate is used for lending against securities for the short term. The reverse repo is used for borrowing against securities. The bank rate is for lending without collateral for the long term. They also use the CRR or cash reserve ratio, which is the minimum percentage of deposits held as cash with the central bank. And they use the SLR or statutory liquidity ratio, which is the minimum percentage of deposits held in cash equivalents like gold and securities. Let us look at how countries interact through international trade and exchange rate. We track this using the balance of payments or BOP structure. This is divided into three accounts. The current account covers transactions on the revenue account, such as imports and exports of goods and services. A deficit here means imports are greater than exports. The capital account covers non-produced, non-financial assets like patents, rights, and capital grants. Finally, the financial account covers FDI, FPI, derivative transactions, and long-term debt. The dynamics are simple but critical. Continuous current account deficits deplete foreign reserves and risk currency depreciation. This global interaction leads us to globalization. Looking at both the positives and negatives. Globalization is defined as the ability to produce or sell anywhere, allowing for the free flow of resources. The positives include better allocation, where resources flow to where they produce best. Integration allows access to new tech and products. Consumer benefits include competition that checks prices and spurs innovation. It also provides cultural access to art and food. However, there are negatives. Competition acts as survival of the fittest, risking leaving less competent talent behind. There are interlinkage risks, meaning a problem in one part affects others, like the 2008 crisis. Also, there is a risk of cultural erosion to age-old traditions. Finally, we'll discuss the role of economic analysis in fundamental analysis. As an investor, your objective is to combine external environment analysis with management execution to forecast growth. The process flows in steps. First, analyze macro factors like GDP growth, monetary and fiscal policy, and inflation. Second, determine the economy trajectory. Is it growing? Check for liquidity support. Is it shrinking? Check for room for rate cuts. Third, assess industry impact. You must translate the economic trajectory to specific industry effects. And fourth, conduct business analysis to determine if the specific business will grow or shrink. This top-down approach ensures your investment decisions are backed by a solid understanding of the economic environment.